Hey everybody, today I want to talk about an important market indicator I've been using for years that's really helped me sidestep some important market drops, and even more importantly, the sizable drops that leading stocks can have when the market pulls back in an uptrend. My typical go-to indicator for understanding when I should be lightening up off of my exposure is my FOMO indicator. This is not that. If you want to learn more about that FOMO indicator, which has become such an integral part of my process to both add to my stocks and reduce my stocks, you can learn more in the video link below for that video. But this is addressing market tops that the FOMO indicator can't catch. And it's very important because, if you understand the way the FOMO indicator works, is that essentially whenever the majority of stocks are above their short-term 5-day average, we have some excessive excitement. Basically, every stock has been purchased in the last couple of days. That usually coincides with important market tops. And likewise, when most stocks are below their short-term average, there's been short-term market fear. That usually lines up with really good buying opportunities. When you're dealing with these very volatile growth stocks, those swings can be really dramatic. You want to try and use that to your advantage the best that you can. But there are environments where that tool just won't work. So if we take a look at the 2023 July top, for example, you'll notice the market topped, we rolled over, but we never had FOMO in the majority of stocks. So what happened in this situation? Well, the way our indexes are built, few stocks have such large market caps, they have really an outsized impact on the indexes. Think of the Mag 7 or the FANGs, whatever you want to call them, all the really large cap tech stocks, etc. Now, in that run-up in July 2023, those stocks had a lot of excitement and some really consistent, persistent strength that eventually led into that market top. But most stocks were not participating. So now that still creates a problem because we need to know when the market's going to have a pullback, regardless of what the FOMO indicator is saying. There's alternate ways that markets can peak. There's alternate situations. This actually really reminded me very much of, in all my hours of study of William O'Neill, legendary investor. For those who don't know him, he's the author of How to Make Money in Stocks. There was one time he was talking where he was saying, you can't have one sell signal. He's like, what if a market or a stock tops and it doesn't tick off that sell signal? What are you going to do? You have to have specific sell signals for the important market scenarios. And so going back, this was an important scenario where, hey, the majority of stocks are not experiencing FOMO or excitement, but these few stocks are, and that's enough to push the market into a deeper correction. So I kind of, took a step back and tried to look at what other ways can I identify market peaks. I don't like price oscillators. For someone who focuses, primarily and almost completely on just high tech, growth companies, if you use a price oscillator, you're almost going to always see these oscillators as overbought. I mean, we've been with Robinhood since the 40s, and just after this market sell-off. I mean, that had many, many periods where you saw overbought price action. A leader should be overbought. People are fighting to buy that stock. I don't want to penalize that stock for good action and sell it. I want to know when there's a heightened probability that the market at large can pull back. That's why I like these market indicators to guide my exposure in these growth stocks. And a key part of this is not about necessarily selling all of your stocks. It's about knowing, like, hey, if you're on margin, or never mind, these stocks can move so aggressively. Even if you're just fully invested, but you're concentrated in some growth stocks, even a 1 or 2 week sell-off can cause tremendous damage if you don't adjust your positioning. Or if you buy too much too late, you can give up weeks or months of profits in a 2 week sell-off. It can be quite vicious. So you really want to plan for all types of market pullbacks. And the frustrating thing is virtually all literature, anything you kind of find, will talk about when to buy stocks. And it's important. That's how you make money in the first place. But if you don't have the tools to get you through the journey, if your portfolio swings are too extreme, it won't help you if you buy the right stocks, because you'll be pushed out of fear somewhere and panic along the way, and you'll be knocked out. So kind of taking all this and kind of looking back in time at different environments, I noticed a really interesting dynamic between what is the VIX, the Volatility Index, and the S&P 500. Now, if we just look at these two symbols next to each other, you'll notice they're almost perfect mirror images of each other. When the S&P 500 goes higher, the VIX comes lower. And when the S&P 500 comes lower, the VIX tends to go higher. So whenever you have a very strong market relationship, you want to take note. And all the more important is when that relationship breaks down. And what is that saying? What does that mean? And in this situation here, it would be very odd to see the S&P 500 climbing and the volatility index climbing as well. Because if we won't go into the the very deep details of it, but essentially the volatility index is the option market's best guess of what the volatility, the daily movement will be for the S&P 500 in the near future. So typically it stands to reason, usually when there's uncertainty and markets are falling, volatility goes up because people are uncertain because they're dealing with this new situation. Like for example, in April with the tariffs that came out and that pushed the market into a correction, the uncertainty of when, what deals will be made, what deals won't be made, what announcements are going to come to market. So that naturally raises the volatility index. If you want to trade options on the S&P, you're going to have to pay higher options prices because everyone's a little less certain. Whereas when you're in a very nice bull market and there's steady accumulation, there's consistent buying day after day, and the daily ranges come down, there's natural confidence in the market. It's normal to see the VIX falling as the market is going higher. So when the market is going higher and the VIX is climbing as well, either there's some kind of uncertainty that the options market is looking at that stock investors are unaware of, or very large investors are in the midst of a market rally are using the options market to begin hedging against what could be a potential pullback. Regardless, it's something that you really want to take note of. So let's take a look at a couple of examples. So if we look first of all at the July 2024 peak, you'll see the FOMO indicator. That did a good job. That was a normal peak, and we saw broad-based FOMO as the market went to its top. But you can also notice here that the VIX was climbing for 9 days along with the S&P 500. And once the market topped, if you take a look at CLS, which was a great leading stock at the time, still moving much, much higher, one we've been focusing on, you'll notice that CLS, after that peak, fell 36% pretty quickly. So it's really something, again, if you're focusing on more aggressive growth type companies, you really want to pay attention when the market is at a potential extreme. How do you refocus your portfolio to be able to protect against potential market pullbacks? Now, if we go back to 2023, again, you'll notice in this situation, it's different. The market put its peak in, but the FOMO indicator did not get to elevated levels. It was, like I mentioned, it was a small group of very large stocks that were driving the indexes higher. So if you were just looking for broad-based euphoria, it wasn't there. But under the surface, you can see going into that top, there was 5 days where there was this divergence where the S&P 500 climbed, and so did the VIX, and that preceded that correction. If we go back to even 2020, in the post-COVID bottom, in that epic bull market that launched, going into September of that year, that September top, you'll notice there wasn't FOMO at the September top, but 6 days prior to that top, you'll notice that the VIX started to climb with the S&P 500. Actually, if you wouldn't have protected against that top, Tesla fell 34% in 4 days after the market topped. And during that period of time, Tesla was a real market leader of that cycle, and it went on to much higher heights. Can you withstand 34% in 4 days? If Tesla pulled that off, other stocks had equally dramatic declines. You need to position yourself in a way where if there's continued advances in a bull market, you participate, but at the same time that you can withstand financially and mentally a pullback, and you don't succumb to panic. The whole point of this business is you need to always be calm, level-headed, and not panic in downtimes or get euphoric in uptimes. These tools that I'm talking about, the FOMO indicator, the VIX, they're critical because they help you at the extremes when to kind of take your foot off the gas. You don't have to go into full cash. It's not about that. And it's more about how do I put myself in a position where if there's a pullback, I can survive it. And so even just recently, the reason I bring up this video is because it's something I used recently, and I was talking about it with clients at Caruso Insights. And if you look at the 6 days leading up to this market pullback, which it's ongoing, but it's in progress, you'll notice that the VIX was climbing with the S&P 500. Now, what did we do? There's a number of stocks we've been holding on to. We have positions in NBIS, we have positions in Hood, we have positions in GEV, all of these great companies, but we also have positions in Ethereum and TEM. Now, those stocks, as we saw the market start to show this odd anomaly, they were some of our weaker holdings. Still profitable, but they were not as strong as others. So we raised our stops, we looked to exit, and we took exposure out of the market. We had been aggressive for a long period of time, but seeing that there's just a heightened probability that we may get a pullback, we used that opportunity to kind of sell off what were lower, I don't want to say lower quality, but stocks that were not our top tier stocks that we have the biggest cushions on, that we have the most confidence in, and that we think have the biggest upside. And so that's really how I like to use this tool. It's not about, hey, we're in an uptrend, we're trying to pick a top. It's about, we see a definitive market data point telling us that there's some kind of change in the normal dynamic of things, which typically precedes tops. How do we start to refocus our position, our portfolio management? The frustrating thing about portfolio management is if you try and pick up a book on it, it's the most boring thing to read in the world. And it's never suited to what most, like the average investor, is doing. The portfolio management is typically geared to funds who are running models, and it's about diversification and working out, managing risk, and very important topics. But for someone who is running a more concentrated portfolio of a few great growth companies, it's not as helpful as it is for someone running a model and a fund. And so most people just go without a plan to reduce exposure at extremes, or without a plan to kind of rethink or refocus their positioning. And it's a critical component because, again, most of the major mistakes, most people can eventually figure out you're in a bull market. Most people can eventually figure out the good stocks. Most people fail because even if they make good money for a while, there's a point in time where they make some really critical errors. And these could be some of the critical errors. Getting too invested too late in a bull market or not taking your foot off the gas at the right time will cause a cascading series of mental and trading errors that can really pretty much almost ruin an entire uptrend. I know out of experience, I've been there. It happens, and it's amazing how one issue leads to another, leads to frustration, leads to more bad ideas, and then you go from being in sync with the market to suddenly you're selling on drops, then you're trying to buy back on rallies, and then the regular volatility knocks you out. So having these important tools that can help guide you when to adjust your positioning, not from a gut perspective, because we all have different tolerances. Some people may make $50,000, they're doing cartwheels. For some other people, it's $500,000 or $5 million. And that'll change as your accounts grow. What really is critical is that you can look at this from a non-personal, non-emotional, unbiased way through market data. And again, you want it to be not stock specific, because leading stocks will stay overbought for extended periods of time. That's why we focus on them. When you can catch the right ones, they're incredible. The key is, how do I know when at large there's a heightened chance for a pullback? And those pullbacks will have an oversized effect on the leading stocks, because usually when those start to run very hot, it's mostly weak hands who do the last buying, people who are late to the trend, buying out of just excitement, and then they're the first to sell, and you get these dramatic swings both ways. So I hope this is something that you can keep in mind, that's something you can monitor closely, and it's something that doesn't happen very often. If you take a look actually at this chart here, you'll see these red highlights on the screen. I've taken this and kind of broken it down to a formula that I shared with clients. We had a market direction workshop a couple of months back. Maybe we'll have one next year where we kind of put this into a formulaic approach. But there's no super magic behind it. Essentially, it's trying to identify these periods of time. But you can see over time that it can very often precede more important market tops. And I'm sure you can build a script yourself or just visually follow it day by day. If you found this helpful, and this is something that's been a lot of help to me, so I hope it's helpful to you, you can learn more at carusoinsights.com. You can follow me on Twitter at Caruso Insights. Of course, I'm here on YouTube with some different videos I like to share whenever I have a topic that I think people will enjoy. Hope to be back soon. We'll talk to you then.